Good afternoon. Welcome to our 2025 House View webinar. I'm Jay Butterfield, and I have with me today Sabrina Unger, ARA's Managing Director and Head of Research and Strategy, and Eric Cannon, Portfolio Manager for our Value Add Strategy. So today we're going to be sharing some of the things that we're focusing on in the economy and capital markets and how we see that translating into opportunities for real estate in the coming year. Now, before we get started, as you all know, the last 2 weeks, Los Angeles has suffered pretty catastrophic impacts from wildfires that have destroyed a lot of property and displaced thousands from their homes. Our headquarters in downtown LA wasn't affected, and our team continues to work in the office and remotely, but we're aware that many of our neighbors and friends and professional colleagues have been put out of their homes, perhaps for some time to come. Also, none of the assets that we manage on behalf of our clients in Southern California were affected, but we're continuing to monitor the situation and as it develops. So we're very grateful for the incredible efforts that the firefighters and first responders have undertaken while they risk their lives to ensure the safety of all of us and everyone in the affected areas. So with that, let's get started. Sabrina, let's start off with you. Can you frame the big picture in the economy as our house view sees it and the capital markets and how these relate to real estate? What can our investors expect going into 2025?
I think at a high level, we feel confident in saying that the soft landing appears to have been achieved, right? Inflation has continued to moderate, the labor market has held up, and GDP growth has not faltered even in the face of higher interest rates. And so as we look ahead, our base case is for the labor market to continue to support the consumer. And that's critical, obviously, for ongoing GDP growth, though we do expect there to be less net job gains going forward. We think inflation could keep improving in the near term, though it may be hard to get to that 2% Fed target, and that is likely to keep rates higher for longer. But overall, the outlook is generally positive.
Well, so can we drill down into that a little bit? So you said the labor market growth supports the consumer, but we're going to have fewer net jobs. How do we reconcile that?
There are two elements in particular that I think our investors will want to keep in mind for the coming cycle when it comes to understanding how we can have a situation where workers can be in a good place and we're having lesser headline job growth. And the first part of that is understanding the shrinking gap between the number of young workers entering the workforce versus the number that are sort of reaching retirement age and may be exiting as we go forward. And so you can sort of see here that relative to the last several decades, this sort of demographic component of the labor market, it's really gearing up to play a much larger role relative to what we had seen. And this is going to impact the potential for the economy to add jobs, but it's also going to have a positive upside for wages, because really what this means is there's fewer net working age people that could come into the labor market. And so again, fewer potential new hires to add to those job numbers, but there's going to be more competition for the folks that are working, and that could easily translate to, again, higher competition and thus higher pay. The other element of this, of course, is what happens on the immigration front. The reality is our domestic birth story in the United States, or really lack of birth story, is not a new one, and this is not unique to the United States. Most advanced economies throughout the world just have fewer and fewer children. And so immigration has been a really large source of population growth in the US for many years, but particularly in the last 4 or 5 years, it was sort of the main driver of overall population growth. And so when we look out ahead, you could anticipate, roughly 2/3 of projected population growth over the next 5 years was going to come from immigration. So if that supply of labor, if the spigot gets shut off, again, I think we're going to see a situation where overall job gains, so those monthly numbers that the Wall Street Journal and other periodicals love to talk about, that's likely to trend lower because we're going to have fewer potential workers, and that lessens the potential to add to payrolls. But that's going to contribute to a situation where wages increase because companies are going to have to compete for the existing workers that we do have. That's going to likely put more money in consumers' pockets, and that's a good thing for the economy, given that spending represents roughly 3/4 of growth. So that's sort of how we get to a place where there's less headline job growth, and yet wages are going up, and consumers are in a relatively good spot.
But what does that mean for inflation? I mean, does this put us at risk for, wage price spiral? And how's that going to affect what's happening in the capital markets?
Yeah, it's a good question. As I sort of noted in our base case, there is already the potential for inflation to trend back up, or at least sort of resist getting to that 2% target. We all sort of know housing is not getting cheaper. We've seen sort of a bottoming and a potential early signs of turnaround in apartment rent growth. So on the housing piece, that's not going to help on the inflation front. And then we have the added component of the potential for tariffs to make imported goods more expensive. And ultimately, some of those increases do get passed to the consumer. So there is a chance that that combination of more wage growth plus tariffs starts to add upside pressure to prices. I think we believe the Fed is going to be more cautious with this leg of the easing cycle because of those embedded inflationary pressures. I think it's going to mean fewer rate cuts than what we have seen in previous easing cycles. I don't think that's necessarily a wild idea. I think interest rates are likely to settle at a basis higher than what we've seen in the last 15 years. But capital markets can operate at higher levels of interest rates. We've seen it in past cycles, really prior to the global financial crisis. Real estate operated just fine as an asset class with higher interest rates. What's arguably more important, at least in the near term, yes, the absolute level of interest rates, but also just the degree of certainty and conviction of where they're headed. And I think markets have adjusted to the idea of higher for longer. I think markets will continue to improve as that certainty gains more traction. And we've already seen it in the capital markets. The cost of capital has come down in some cases by as much as a couple hundred basis points, depending on the quality of the asset and the loan duration. Banks are gradually starting to loosen their purse strings when it comes to real estate lending. And now there's a whole host of other real estate lenders who are bringing dry powder to the table. And so what that's doing is helping liquidity recover in our asset class. So there's a good reason to believe that that pivot in returns that we saw in the back half of 2024, that should start to continue to firm up a little bit as we move through this year.
Thanks. So with that backdrop, let's turn then to what does that mean for us as real estate investors? I mean, what types of opportunities does this scenario, afford to us? So Eric, maybe you can give us a few examples when it comes to how we're thinking about property markets and how we're moving forward.
Sure, Jay. Well, I think thematically a big driver of what is expected to occur in the property markets this year and really for the next couple of years is the dramatic slowing in new supply or projects under construction we're seeing occur. So the last couple of years were high watermark years in terms of deliveries, particularly in the multifamily and industrial sectors, and that overhang of supply has been a drag on fundamentals. But the good news is that across the board, in basically every property sector, pipelines are down 30, 40% or more on a year-over-year basis. And with the economy expected to remain healthy, that's really setting up the next couple of years to see fundamentals improve and allow rent growth to resume. So that scenario bodes well for potential cash flow growth in the existing portfolios of our funds. One area that we're particularly focused on this dynamic coming into play in a beneficial way for investors is on the residential side. So we've talked a lot about this before, but I think it bears repeating that the for sale market remains frustratingly inaccessible to many would-be buyers. The average effective rate on mortgages outstanding today is over 200 basis points below what a new mortgage would be if you were to go out and procure a new mortgage to buy a home. And so what that's doing is keeping homeowners in place longer and really locking up that inventory of resale product. At the same time, we're seeing a greater willingness of households to want to move. You can see this increased mobility in the chart here. Now, why is that? It could be a function of a couple of different things. People feeling more confident about their ability to get a job, different job somewhere else. They're making more money, or there are more rental options, and so they're not as tied down to staying in the same place. We're seeing that on the demand side too. Absorption in most apartment markets in 2024, if you look at it as a percent of existing inventory, was higher than in either 2023 or 2022. And so renters are really benefiting from that labor dynamic that Sabrina was outlining earlier, and it's translating into demand for rentals. Moving forward, our expectation for the residential sector is with new construction starts plummeting and strong sustained rental demand, that we'll see improved pricing power for owners. And we're going to continue to lean in on investing in residential. It's currently the largest sector exposure in our value-added strategy. It's the second largest in our core strategy. And we've also launched a dedicated sector-specific opportunistic vehicle to pursue residential investments.
Okay, so that's residential, but what about industrial? So are you seeing a supply drop-off happening in industrial also?
We absolutely are. If you think about the capital market conditions we saw in late 2023 and all of last year, they made it much more difficult for developers to make new projects pencil, especially with fundamentals getting softer. So we've seen construction pipelines decline, in some markets by 50 to 80% where we own industrial properties, like, for example, in Atlanta or Lehigh Valley of Eastern Pennsylvania or Dallas or South Florida. Now, tariffs could prolong the industrial recovery a bit, though, if imports take a big hit.
I think just to add on to that, some of the uncertainty that did sideline industrial occupiers from making space decisions last year, specifically related to the economy and how we were going to track, I think some of that has subsided a bit, just given how consistently strong the labor market and the economy has been. And I think this potential for tariffs on their businesses may actually prompt some industrial users to front load inventory and start taking on more leasing activity to try to get ahead of the tariffs being applied. Already we're starting to see a growing share of markets nationwide see an uptick in absorption relative to their bottoms. So if we're sort of looking at the chart here, this is, effectively a different version of a diffusion index, and it looks at the percentage of markets nationwide where either net absorption is sort of strengthening or weakening. And you can see the early part of 2024, not a lot of markets were improving on a year-over-year basis. But I think as groups started to recognize the potential for tariffs on their businesses, you could see that uptick in leasing activity in the back half of the year. We think that probably continues, at least in the near term, as companies seek to bring in their goods ahead of tariffs being applied.
Okay, so we feel good about residential and industrial prospects, but the news always seems to be focused on office, and everybody wants to know what's going on there. I mean, are there any bright spots? Is sort of the worst behind us?
Well, I would say there are some early signs that office might be stabilizing, but we're calling for a more cautious optimism. Certainly, we're seeing more and more companies call folks back to the office for sure. And leasing activity in certain desirable submarkets of certain markets across the country has started to approach pre-pandemic levels. Think, for example, the Plaza District of Manhattan, Brickell and Miami Beach of Miami, or Century City in LA. But we still think there's real risk there. If you take a look at real effective rents, so this is rents adjusted for concessions, tenant improvement dollars, commissions, and inflation, they continue to firmly trend negative on a year-over-year basis, as tenants are expecting landlords to spend more to make their spaces nice. So let's take, for example, you own a 300,000 square foot multi-tenant office property. For simplicity's sake, it's a 10-story building. You have a 30,000 square foot floor plate. In most markets and most office buildings across the country right now, if you have a tenant prospect looking to lease, let's say 10,000 square feet or 1/3 of one floor, so that tenant is just 3.33% of the overall rentable area of the building. But in most cases, they have the leverage in today's market and operating environment to, in addition to the TI, LC, and free rent associated with their actual space, they may require the landlord to renovate the entire common area, elevator landing, corridors, and bathrooms on that floor. And by the same token, we're seeing office users in the market increasingly desiring flexibility in lease term. So shorter lease duration, being less willing to commit to a 10 or 15-year lease. So if you think about that economically from an owner's perspective, it's a much greater cost amortized over a much shorter period of time. So it makes it difficult to achieve an appropriate return on investment. Lastly, I would say, the employment backdrop Sabrina was talking about earlier, it's also a factor for us being more cautious here. So you're looking at fewer net new job gains in office using employment, and that's likely to translate to less demand growth, which is adding to what we're already seeing in terms of the structural erosion of demand due to hybrid work. So the bottom line is that we think there are still a lot of hurdles to clear on office, even given the reset pricing backdrop.
Okay, so let's stay on repricing. So we're saying there's a lot of reasons to be optimistic about the prospects for real estate this year. Sabrina mentioned, better times are ahead, but does that mean we've sort of really turned the corner on returns? And so as an investor, what would you expect for this year?
Well, what history tells us is that new capital market cycles, which, we're sort of defining as when the Fed switches from, sort of a restrictive stance to the start of easing. In history, when they've done that, that has typically led to multi-year periods where real estate performs quite strongly. What we're looking at here is these different historical periods where the Fed made that pivot and started easing, and what were the cumulative returns on a 1, 2, and 3-year basis following the start of that. I think for me, what's compelling about this is, number one, and for our investors, of course, it's helpful to understand that, the start of these cycles has led to some pretty strong performance. But I also think is that it's interesting that in each of these different historic scenarios, the economic, capital markets, and real estate fundamental conditions surrounding these periods were being influenced by decidedly different factors, and yet the outcomes were largely the same. It's largely positive starting easing, even with a backdrop of different, sort of drivers on the macro front, capital markets, and what have you. And so even if some things are different this time around, and of course they will be because no cycle is exactly the same, there's still good reason to think that the start of the Fed easing cycle that began in September should, help us get into a scenario where the positive returns that we saw in Q3 and Q4 of 2024 continue and also continue to strengthen as the cycle progresses.
Okay, that's good news, but where are we going to expect to see these returns? So as an investor, where should I be putting my dollar in real estate today? I mean, if everybody's, positive on residential and industrial, how are we identifying the right opportunities?
Well, it's a great question. And I would say, on account of the higher for longer scenario that Sabrina was outlining earlier, we're very focused right now on investments where we can create high unlevered yields, really as a margin of safety to be less heavily reliant on accommodative exit cap rates. And, it's to your point about competition and the, focus of investors in the marketplace being mostly on residential and industrial. For us, we're constantly paying attention to where capital is and where capital isn't at any particular moment in the marketplace. And this helps inform our new investment sourcing efforts to not be spending too much time on those, more overheated competitive situations. So an example of that would be right now, there's a lot of, interest in potential industrial acquisition opportunities that have a significantly below market in place rents and near-term lease over, let's say in the first year or two of a new investor's hold period. On the other hand, across the board right now, we're seeing less equity in the market looking at development. So in certain markets, particularly with the backdrop I was talking about earlier of significantly reduced supply, it may actually make sense to lean into those falling construction pipelines and develop new product that will deliver in a period of less expected competition. So, when most capital is focused on developing or acquiring bulk industrial, we're sort of more interested in seeing if there's opportunity in small bay or medium-sized footprint industrial. And when most investors are largely focused on top of the market luxury rental housing product, we're spending a little more time on middle market or attainable rental housing product.
Thanks. So in times like this, everybody talks about distress, and somehow it never seems to materialize. Is there distress in the market, and what's the opportunity to take advantage of it?
Well, there's certainly no doubt there's been no floodgate of distress, and less of distress than one would have anticipated looking at just the absolute dollar amount of loan maturities happening in 2023, 2024, and moving forward. But that doesn't mean that there aren't upside down balance sheets in the market. If you look at data from MSCI as of the third quarter of 2024, there was in excess of $100 billion of actual distress. Those are properties that were taken back by lenders or loans that are currently in default, and potential distress or subperforming assets were more than 2 times that. And while a good portion of that comprises office properties, about 35% of it was actually multifamily and retail. And so we are seeing a need for a capital infusion of assets in the marketplace to either complete a business plan or deal with a maturing loan issue and a shortfall. They're both outright acquisition opportunities as well as structured investments in undercapitalized assets.
Great, thanks, Eric. So to summarize, the economy seems to be on stable footing with the Fed, apparently achieving a soft landing that we've all been looking for. We've got positives in the labor market, inflation generally trending in the right direction, and an outlook for, greater stability in interest rates, although we may be in for more higher for longer than previously expected. Looks like supply and demand factors are favoring residential and industrial, with a drop-off in new supply coming online, favoring high-quality, well-leased existing assets in portfolios. And office, on the other hand, still has a way to go before we can really see any attractive opportunities. Overall, going into 2025, it looks like valuations have stabilized in most sectors. So this gives buyers and sellers and investors more confidence to transact, and that further opens up markets. And returns, well, we're expecting them to trend back more towards normal historical levels as good fundamentals and income strategies are providing our investors with interesting opportunities over the next several years. So we had a few questions that some of our attendees submitted ahead of time, and we can address a few of them. And I'd like to start off with, recent news, jobs data in December. So this was pretty strong, and inflation trended up. How does that influence our view of the soft landing?
Yeah, I mean, I think the job numbers coming in above consensus in December, I think really does help support the idea that the economy, as being measured through the labor market, has not succumbed in a negative way to higher interest rates. And I think does support the idea that the soft landing has been achieved. I think it was a good sign, the December data, because there were some concerns that the labor market had some cracks underlying it, and that it may not have actually been as strong as the sort of headline data was suggesting. And I think this latest data point coming out of December suggests we are, in fact, in a pretty good position. But when we, layer in that inflation number, yes, I think the headline CPI number accelerated a bit in December, but the core metrics, so removing, energy and food prices, which are notoriously volatile anyway, that core metric actually rose less than expected. And if you watched the stock market after that data came out, you saw the market surge. And I think the general view is that that happened because the market felt more optimistic about the inflation and policy path going forward as a result of that core metric coming in below expectations. Look, the question related to how does it influence our view of a soft landing, I think at some point we have to make a call about whether the soft landing from the pandemic has been achieved. And I think we're there. And I think this is an important distinction. The inflation that we expect or anticipate to face going forward is likely going to be a function of broader, longer term forces. So demographics, again, fewer new entrants coming into the labor market versus those retiring, potential for less immigration. We have these other elements, there's geopolitical things at play. And that is a fundamentally sort of different inflation dynamic than the stimulus-driven spending or supply chain snarl related inflation that we saw coming out of the pandemic. And I think that was first and foremost what the Fed was tasked with unraveling. I think they've done it. And now we're sort of entering a different dynamic underpinned by different drivers. So they still have work to do. I don't think they're going to get to take a break, but the pandemic related inflation fight and the goal of a soft landing, I think we're still there.
Well, speaking of different dynamics, this week we have a new administration in Washington. So how do you think the potential for new government policies will be affecting our outlook?
I can take a stab at that. I think we can assume a few things will happen. First and foremost is there's likely to be some level of tariffs applied. The question is whether it's going to be sort of broad sweeping or specific. Are there going to be certain industries that maybe find a way to get an exemption? And so the breadth and depth of those tariffs is likely going to have the greatest influence on the path of inflation going forward. And that's obviously going to have an impact on policy rates. So we're certainly watching that. And I think the second element, and it's something we mentioned earlier, is we do expect a slowdown in the pace of immigration coming into the country, and that is likely to have ripple effects on growth down the line. We mentioned that immigration has been a large source of population growth over the last several years, and that has continued to feed capacity into the labor market. And so a less friendly administration towards immigration would slow that inflow. Now, I say that with the caveat of we won't likely see that impact, that negative drag on growth and job growth, probably for a couple years. Because typically when people come into the country, they don't immediately enter the formalized labor pool right away. So we may still see labor force capacity and job gains actually hold up over the next year or two, because that's going to come from those folks who immigrated over the last couple of years and are already in the country and begin to enter the labor force. But really, I think starting in 2027 and beyond, you could see a potential drop in the number of workers, and that is inherently inflationary as well, because fewer workers means greater competition and more wages. So I think those are sort of the impacts we could realistically envision from the new administration.
Okay, thanks. So Eric, we're seeing a lot of chatter today about technological advancement and AI. It seems to be on everybody's tongue, and the potential impact on data center demand. So is there an opportunity in data centers?
Well, that's a great question, whoever submitted it. There's obviously been an incredible amount of investment and spending in the digitization of the U.S. economy. By some estimates, the investment could be in excess of $1.5 trillion over the next several years just in the U.S. And there's certainly been a lot of fervor for the data center sector. But in my view, time will tell whether the optimism and exuberance embodied in some of the underwriting assumptions today for these investments turns out to be warranted. From my perspective, these investments tend to be very large and very concentrated, so into the hundreds of millions of dollars and billions of dollars. And I think we need to see how exit liquidity at retail pricing levels ultimately plays out. It could prove challenging. We're certainly not blind to this potential, but right now we're a little more focused on offshoot or derivative plays that benefit from this growth. For example, one strategy is acquiring traditional warehouse industrial located in submarkets with a declining supply of that product due to all the available land and older existing industrial facilities being developed or converted into data center space.
Thanks, Eric. So that brings us to the end of our webinar. I want to thank all of you for attending, and also thank Sabrina and Eric for their comments and their insight. So as you can tell, we're excited about the coming year and the opportunities in real estate investment that it brings, and we're happy to discuss our outlook further. Our full 2025 house view, as well as a recording of this webinar, will be available later this week, and we encourage you to review it and share it with your colleagues. Thanks again. We appreciate your interest. If you have any other questions or would like more information, please contact us directly or visit our website, aracapital.com. Thanks.